I would like to invite Dhinal sir and Rinkesh sir on the dais. It's with great honor to introduce you to CA Dhinal Shah, who is an advocate and a chartered accountant, a titan in the field of finance and law with over 30 years of experience in advising clients on tax, exchange control, laws, and a lot more. As a former partner of E&Y and also a Central Council member of our own ICAI, chairman of our organizing event Direct Tax Committee of Gujarat Chamber of Commerce and Industry, he has left an incredible mark. Sir is extensively involved in advising corporate issues, double tax treaties, due diligence, transfer pricing, and the list goes on. So let's not wait, and please join me in extending a warm welcome to our respected CA Dhinal Shah. I would call Rinkesh sir to felicitate our...
Yes, sir.
Thank you, sir. I would like to call CA Dhinal Shah sir on the post. All yours, sir.
Good afternoon, and sorry for being late. And thank you to Ahmedabad branch and the institute for giving this opportunity to share some thoughts. Rinkesh, Nikita, Vaibhav, seniors in the friends, and the professional friends. And let me take 3 minutes to give you some perspective on this topic. Everybody, one of us, is practicing on tax for 1 year to 40, 50 years. But it has changed substantially in last 10 years because of the use of technology, because of the use of the information and the data which government gets, including the non-residents who are having a substantial investment in India, who used to be indifferent to the compliance of law in India. And therefore, the practice is becoming more and more compliance-oriented. Every alternate day, you get some intimation from CPC, and you file 154, CPC does not understand. And if I just take a simple example, CPC, even if I have a turnover less than 1 crore, but if I have a write back of 15 crore, they reject my return and file a defective return because you have not got your accounts audited. The Institute Guidance Note says the write back of a suppliers or a creditors, including income under 41(1), is not subject to a gross receipt or turnover for 44AB. And then ultimately the returns are found defective under 139(9). And then you litigate at some judicial forum. What is changing in last 10 years is substantial cross-border transaction, substantial non-resident investment on both the sides. So your clients makes investment, substantial investment under LRS, ODI in the foreign country. And there are large number of Indian investors who are investing in India. And the India growth story will continue. And therefore, what is changing is the importance of the cross-border transaction related tax, and including FEMA. Because FEMA, though it has traveled almost 25 years after FIMA Act of 99, but it is all related to a policy level approach by the RBI, and therefore substantial compliances, substantial non-compliances and compounding, and every banker, including every branch of a bank, would take a different view on the action control compliance. And therefore understanding of these principles is relevant, number one. Number two, the income tax department, particularly on the cross-border transactions and when you sign 15 CB, they get data from the banks from 15 CC data and then start a general inquiry with all of us client, that please explain each transaction, that why have you deducted or why have you not deducted the TDS. In large companies, there are 1,000 line items, 2,000 line items, and which each of the item you need to go and explain that why you adopted a particular approach, and where the person who is signing 15 CB has an additional obligation to demonstrate his professional judgment for taking a particular view. The second thing, and which I believe there is a likelihood of a budget provision in July about what is called a Pillar 2, which is part of an OECD. And there is a huge debate, discussion going on in the North Bloc that should we introduce Pillar 2 as a part of the budget. Now, what is changing between your 100 years or decades old concept of a physical presence of a business versus a virtual presence of a business? Today, there is a physical presence of a business by importing goods and exporting goods. But on a similar principle, there is a virtual provision of a services and a virtual provision of an outbound services. I know many people in Ahmedabad, Baroda, in Gujarat, they manage large companies' servers sitting in Ahmedabad or Baroda. And it is a reverse situation also, that there is a virtual provision of a services by large professionals outside India. And the concept which is changing, which is being accepted globally, that it is not only the physical presence which is relevant, but it is also the virtual presence which is relevant, and that is the offshoot is the equalization levy and your significant economic presence under Section 9. And the second principle, along with virtual presence, is the market or the consumers where they are located. So if a US company has a sales worth $1 billion in India, without a distributor, without a branch, without a subsidiary company, today that income is not taxable in India, but tomorrow part of the income could become taxable in India because market is India, the consumers are in India, the entire base of the business is India. And therefore, my one request to all of you is that it's an interesting subject, it's an evolving subject. Whatever I say right now may not hold true in the afternoon because of some judgment of an High Court or tribunal or some decisions which government may take. And it's an interesting area of practice, and therefore my only suggestion to all of you, that particularly youngsters, that you must start learning. Mere certification of an international course or mere attending this seminar, with all respect to everybody, may not help. You will have to put hard work, what you did in CA exam, on the subject and understanding the FEMA. Let me come to the subject proper. Let me take a simple example, and which many of us would know, but at the cost of repetition, let me try. A Suzuki India Private Limited manufacturing a Maruti car in India exports the cars to Thailand, Malaysia, Singapore, Australia, and receives payment in a foreign currency to India. The opposite example is that a BMW or a Mercedes or a Rolls-Royce manufactures cars in Germany and exports those cars to India. Could, in a first example, a foreign country can go and sell to Suzuki Maruti that your part of the profit is taxable in our country because the customers are in those countries. You did the research activity in India, you did a manufacturing activity in India, you did the entire operations and management in India, but the marketing was done in the Southeast countries. And in the opposite situation, a Mercedes or a BMW being sold in India, and can an Indian government go and say to a Mercedes, BMW, Rolls-Royce that your part of the profit should be taxable in India because your marketing efforts are in India? Today, as the law stands, and subject to what will happen in future, which I said a few minutes back, today in both the situations, our profits are not taxable in the southeastern countries or in India because what is called a business connection, which we use a terminology in Indian law, or we use a treaty called permanent establishment. But a classic example is a Supreme Court judgment in Formula One, where a 3-day race in India was treated as a fixed place of business, carrying on an economic activity in India, and therefore the entire race of Formula One for 3 days was treated as having a permanent establishment in India. So the duration of an activity may not be relevant. What is relevant is that am I doing an economic activity in India, on the soil of India, for the purpose of earning the profits? If answer is yes, then you would have some consequences. Now each fact would depend, and therefore it is not possible to generalize what Supreme Court said in Formula One or what a Suzuki Maruti would take a view in the foreign country or what the BMW Mercedes will take from an Indian perspective. But the economic activity on the soil of India is an important factor. The majority of the disputes today happens on royalties and fees for technical services. From a department perspective, every payment in the nature of service should fall into one of the category. Every payment, whether you make a marketing services, whether you pay a sales commission, whether you pay a cloud server hosting charges, whether you pay a lease line charges, whether you pay a software, whether you reimburse an expenditure, according to the department, it should fall in one of the category. And according to the department, the definition is so wide, particularly after the insertion of explanation 4, 5, and 6 from retrospective effect from 1st July 1976, everything falls into royalty or FTS. And if you see even the tribunal judgments, sometimes you feel that they are not consistent in taking a view. A credit rating money paid in Australia, the Bombay Tribunal, one bench took a view, it is not taxable in India. Exactly opposite view, another tribunal of a Bombay bench took a view that it is taxable in India. In the same country, same agency, only the payer was different. And therefore, my personal view and what I look at as a practice, sometimes we jump from judgment to the facts, which with all respect to everybody is not a correct approach. You first need to understand the facts, law, and then apply judgment to those facts. And don't fix your facts into a judgment, and because that judgment is applicable to me. And don't start your submissions and argument from a judgment and then go and say, these judgment and my facts are same. It is exactly opposite. And I have seen this in many 15CB certificates and many tax appeals and many ITAT appeals, that sometimes we follow an inappropriate professional approach. What section 195 provides? It's a 3 limbs. Any payment or any person making a payment to a non-resident in respect of income chargeable to tax shall deduct TDS at the rates or rates in force other than the salary income in compliance with the law. So any person to a non-resident in respect of income chargeable to tax at the rates or rates in force, and it excludes salary. If you look at section 192 versus 194J, 194J says any payment made to a resident. 192 does not make a resident or a non-resident. It makes any payment in the nature of a salary. And therefore, if you make a cross-border salary payment, section 192 applies, section 195 does not apply. But if you make a consultancy or a professional services, 195 would apply, 194J or 194C would not apply. Now, any person to a non-resident would mean that any person would include a resident or a non-resident. And therefore, let's take a simple example, and I give you yesterday's inquiry from some professional. There is a company in India called Private Limited X, whose shares are held by a UK company, and UK company wants to sell 100% shares of the Indian company to a US company. And therefore, the US company would make $1 million payment to a UK company in relation to the shares of the Indian company. The question is whether that income is chargeable to tax in India. Now, if I apply these principles, it says any person which is resident or a non-resident, and therefore the US being a non-resident would get covered in the 195. Making a payment to another non-resident, which is a UK company, in respect of income chargeable to tax, shall deduct TDS at rates or rates in force. The question is whether income is chargeable to tax or not. And what sometimes a confusion which creates, that is this a situation covered under so-called Vodafone scenario, which is called indirect transfer tax, or is it otherwise? In these facts, irrespective of the Vodafone, the income is taxable in India. There is no need to apply Vodafone, there is no need to apply indirect transfer, there is no need to apply explanation 5 to section 911, because it is a direct transfer of an Indian company's shares which is registered in India, the citers of the shares are in India, and therefore it is any transfer of a capital asset situated in India under 911. Even the department is not aware that in a direct transfer, I don't need to apply Vodafone, because it's a direct transfer of an Indian company's shares. And in this case, if income is chargeable to tax, the US company would be obliged to comply 195 while making a payment to a UK company. And therefore, the first principle is that whether income is chargeable to tax or not. Then you have 195.2, 195.3, which let me skip, but only for the understanding of the principles. The Supreme Court in GE Technology has now clarified that for every payment I don't need to approach a tax department under 195(2). If a chartered accountant after due diligence takes a view that particular income is taxable, not taxable, then department can start 201 proceedings, but I don't need to go to 195(2) to every payment made to a non-resident. And then you have a subsection 3, 4, 5, 6, 7. Let me skip all those and let me go to the principles of what is income chargeable to tax. Section 4, 5, 6, 9, all of us would have read in the final exams of the institute. And I'm not sure all of us would have read after that. But section 4, which is a basis of charge, provides subsection 1 says, any income of a previous year of any person shall be chargeable to tax. Subsection 2 says, if income is chargeable to tax, then I need to discharge a liability through an advance tax, self-assessment or a TDS. Coincidentally, TCS is missing in subsection 2. And therefore, under section 4, it has to be an income. What is income? It's a different subject. But unless there is an income, you don't enter Income Tax Act. I don't need to go to section 5, 6, 9 or even 195 as far as applicability of law is concerned. And there is a classic judgment of a Bombay High Court in Siemens on a reimbursement of an expenses. The Supreme Court said, if it is a pure reimbursement of an expenses, then section 4 does not apply because it is not an income at all. And if it is not an income, I don't need to even evaluate section 5, 6, 9 or section 28. And therefore, it has to be an income. But let me take 2-3 minutes on reimbursement of an expense. There is a complete misnomer on what is reimbursement of an expense, and which is now further escalated by a department under 194R circular. What is reimbursement? Principally, the reimbursement would include an expenditure incurred on behalf of somebody, which the obligation to incur that expenditure was of X, but Y has incurred and Y is getting a reimbursement from X. So there has to be an obligation of X and the incurrence of an expenditure were Y, that Y is recovering from X on the expenses. But if I as an advocate charge 10% clerkage on my invoice, that is not reimbursement. If somebody says I will charge 50,000 as a reimbursement of expenses, that is not reimbursement. A foreign company, large MNCs, have a common IT server and IT support wing. They buy SAP or Oracle licenses globally, and per user cost is recovered from the Indian subsidiary. The question is whether that recovery is a reimbursement of an expenses. Again, answer would be no. A cost allocation or a cost sharing arrangement in a pharma or a research world, is it a reimbursement of an expenses? Answer is no. And therefore, typically, the reimbursement of an expenses would include only those expenses which I have incurred on behalf of somebody which he was obliged to incur. And it is supported by the evidences, backup invoices, like airfare, like hotel, like other expenses which are incurred by somebody. But if the foreign company appoints a McKinsey for providing a consultancy services globally to all entities, and 10% fees is for Indian subsidiary, the US company makes payment to McKinsey and they recover the 10% cost for me. Is it a reimbursement? Again, answer is no. The law is well settled that if I would have made payment to McKinsey directly, what would have been a tax position? Just because it is routed through my parent company, that itself does not become a reimbursement. And therefore, when you apply reimbursement, take appropriate care that it does not fall into a services rather than an actual reimbursement of an expenses. And this problem which government escalated in 194R circular, that you have a GST principle called principal agent, and under principal agent relationship, the GST circular says that if an agent has incurred an expenditure on behalf of a principal, then it's a reimbursement. You don't need to apply GST. The same principle is followed in July 2023 circular under 194R, that you should follow principal agent relationship. The only question, if I ask myself, that if I am a professional and traveling to Bombay for some ITAT hearing and I incur 8,000 rupees of travel expenses, am I acting as an agent of my client? The principal's answer is no. And if answer is no, then can tomorrow somebody says there is no principal agent relationship, and therefore this reimbursement is nothing but an income taxable, and therefore you will obliged to do a TDS under 194 J or C, whichever section is applicable. And therefore please take care as far as reimbursement of an expenses is concerned. Section 5 subsection 2 defines what is called a scope of total income. In case of a non-resident, the income which is deemed to accrue or arise in India or actual accrue to arise in India is taxable in India, or it is received in India or deemed to be received in India is taxable. Now this is whatever I am saying right now is subject to the treaty benefits. And therefore even if the income is not accrued, but if it is received in India or if it is deemed to be received in India, it becomes taxable. Way back, 40 years back, the Supreme Court in Toshuku took a view that a mere passing of a credit entry in the books of the Indian company does not create accrual or arising in India. Neither it is received or deemed to be received, and therefore mere passing of an accounting entry does not create a chargeability under the Income Tax Act. But that decision was distinguished by Supreme Court in Kanchanjunga to say that in that decision income did not accrue, but on the facts of Kanchanjunga, the income was deemed to be received in India because the foreign party had a domain or control over the money. And therefore, if a foreign party creates a domain or control over the money, though actual there is no credit in the bank account, then also it is treated as deemed to received in India. In those facts, India did not have a treaty with Hong Kong, and therefore I was not able to apply India-Hong Kong treaty. Now you have a treaty in last 10 years. And therefore accrue, arise, deemed to accrue or arise, received or deemed to be received. What is deemed to accrue or arise is explained in section 9. So section 9 is nothing but an extension of 5(2) subclause 1. Section 6, a residential status. I don't want to go into section 6 on 182 days and everything. I only wanted to take 1 minute on the place of effective management on section 6, subsection 3. All Indian parents who has a subsidiary outside India, by culture, all overseas companies are controlled and managed from India. It's by culture, it's not by law. Because I as an Indian promoter do not want to give banking powers to somebody. I as an Indian promoter wants to control entire overseas business sitting in India. So government realized this, and government said, we will give you an exemption up to 50 crore of turnover of an overseas company, not to apply POEM principles. So up to 50 crore, POEM does not apply. It's a relaxation from applicability. But if it exceeds 50 crore, then principally POEM will apply. Now whether department takes a view, does not take a view, makes an inquiry, that's a different thing. But conceptually section 6 subsection 3 would apply. And therefore, as a practice, we must advise client that initially you may follow a particular practice of managing the business, but gradually you need to change your decision-making process, including operations. In 90% cases, the books of accounts are also maintained in Tally in India. And therefore, those practices has to change over a period of time once you grow as a business beyond up 50 crore turnover. Section 9. Section 9, as I said, is an extension of 5 to 1. And therefore, subclause 1 has 4 limbs. Limb 1, it's called a business connection. And all of you must read the R.D. Agarwal judgment of a Supreme Court, 56 ITR, page 20, and Vishakhapatnam Port Trust of 144 ITR. These two are the landmark judgment of a Supreme Court on what is business connection. What is business connection, which I started earlier under Formula 1 principle, that am I carrying on the business in India versus with India? If I am carrying on business in India as an economic activity to earn a profit, then it would create a business connection. The distinction between a business connection and a permanent establishment, we use this terminology very generally and very casually. But business connection is a terminology which is a principle or a concept, whereas permanent establishment is a rule-based application. If I follow these rules, I may create a P. If I don't follow these rules, I may not create a P. And therefore, it is a narrower definition than what is called a business connection. A foreign company having a subsidiary company in India, which holds 100% shares, by virtue of shareholding, I do not create a business connection. But if I have a branch office, then answer is yes, that branch would be for economic activity, and therefore it would create a business connection. And therefore this principle between holding a shares of an Indian company versus carrying on the economic activity are two different things. One important concept which is there on statute and for which I don't have an answer, but let me explain you, is called significant economic presence. Explanation 2A was inserted from 1st April 21, and then there was a notification or rule called 11 UAD, notified on 18th May 21. And the law says that if I create an SCP, then it's a deemed business connection under 911. What is SCP? The significant economic present principle, which is explained in explanation 2A, is that if a foreigner or a non-resident sells goods worth more than 2 crores to an Indian buyer, and it is limit is by qua seller and not qua buyer, and therefore if I sell to 10 people each of 15 lakhs, each of 20 lakhs, then also I would create an SCP, I will fall into an SCP definition. Or there is an excess of the users of more than 3 lakhs on my database, on my software, on my online product. If I fulfill either of the principle, then it would create what is called a significant economic presence, and by virtue of which I will create a business connection. So what happens? Your every client, when he imports goods from a foreign supplier, more than 2 crores, you actually have to do a TDS at 42% on the purchases unless you get a certificate under 197 from a tax department. So all of you, when you sign 15 CB on purchase of goods, under the domestic law, I will come to treat it separately, under the domestic law, and if the amount is more than 2 crore, you cannot say that there is no business connection and therefore there is no income chargeable to tax. So all your 15 CB certificate, principally on the domestic tax provisions, if the amount of purchases are more than 2 crores, then you fall into SEP and are deemed a business connection. What is the answer? There is no answer. Answer only lies in the North Block. Even North Block do not have an answer. The law is there from 1st April 21. At least to my experience in last 2.5 years, nobody has raised this issue because government is also aware this is a problem. But if I go to treaty, I have a permanent establishment principle. I do not have an SEP under the Article 5 of the treaty or Article 7 of the treaty. And therefore, if I take a treaty benefit, then this income is not chargeable to tax in India. And therefore, when I sign 15 CB, I can say there is no permanent establishment in India, and therefore there is no need to do any TDS. But the problem is now different. The moment I take a treaty benefit, Section 90 says you must obtain TRC and 10F. Can I go and ask every supplier to give me a TRC? The answer is no. You will actually close the business. So it's between a survival versus an income tax compliance. And therefore, today, practically, every business in India who purchases goods more than 1 crore from a foreign supplier makes a non-compliance of a law as the law stands today. If you go and ask your client please ask that foreign supplier to give me TRC, now from 1st October 23, even a 10F has become an online. You get an OTP, you get these, even I don't know how to do that. And it's very, very painful for a foreign supplier. I was talking to some client day before yesterday, and when I explained to him 10F in a US, he said, Mr. Shah, it is better not to do business with India. And therefore, the only point of bringing to a notice was, yes, there is a law, and with due diligence and with knowledge, we know that we are not complying. The dependent business connection or a dependent permanent establishment. Something which I can't do directly, I can't do indirectly. So instead of setting up a branch in India, I appoint a distributor and I say, you will do what I say. If I make that statement, then that agent becomes a dependent business connection, and therefore there is a business connection implications. The only question is, do I need to comply or pay additional tax? Today, if the transaction is arm's length, the answer is no. If transaction is not on arm's length, answer is yes. Some discussion is going on at the Supreme Court to distinguish a Supreme Court judgment of Morgan Stanley. Let's see what happens in next 6 to 8 months. Subclause 2, the second foundation of 911, transfer of a capital asset situated in India. As I said earlier on that US-UK example, if the capital asset is situated in India, then that income is deemed to accrue arise in India. The offshoot of that, after the Vodafone judgment, was directly or indirectly words were inserted by Finance Act. Initially it was retrospective. In 2022 budget, they made it prospective. What is that indirect transfer tax? I'll just 1 minute. Every one of us it may not be relevant. But the only principle what Supreme Court said in Vodafone or now the law is that if I do a transaction outside India, but if that valuation or that value which is derived from that business is deriving from an India more than 50%, or if it is more than 10 crores, then there could be an implication of indirect transfer of a capital asset situated in India. So what is relevant is that whenever your client does a transaction overseas, please evaluate that that valuation report should not include India business with more than 50% value. And there is a rules, formula, everything is available under the law. Transfer of a property situated in India, and the transfer of property would include both movable and immovable. So all your real estate transaction with a non-resident are subject to 195, because even if you go to treaty, in case of an immovable property, it would always be taxable in the country in which the property is situated. And therefore, when I buy a property from a non-resident, I have an obligation to deduct TDS not under 194IA, it would fall into 195, and whatever taxes would apply. Or you take certificate from Department of 197. Only practical question is, how do I know that the seller is a non-resident? Because in 7 out of 10 cases, they do not make a right representation. They actually file return as resident in India. They give you your PAN, they give you your Aadhaar, and you don't know whether he's a non-resident or a resident. My personal view, that if I have his PAN, if I have his Aadhaar, if I have his income tax return copy to say that I am a resident, then at least as far as deductor is concerned, I do not have a further obligation. I will comply 194IA. I can face a consequences under 201, but my understanding is that it is for him to pay tax and not as a deductor. Because I could not have done beyond this of taking an appropriate representation and appropriate documents to satisfy that a seller was a non-resident or a resident. And the fourth is a source of income in India. And this source is a very, very open, debatable, sensitive terminology. Mere export of a goods outside India does not shift the source from India to outside. But in a case of the Gujarat High Court judgment in Motif, the High Court took a view that if my customers are outside India and I obtain certain services for those customers, then there's availment of a services is for a source of income outside India and therefore not taxable under 917 subclause B. And therefore you will find both sides judgment where a mere having a customers outside India does I shift the source from India to outside. And there are contrary judgments also. 912 is a salary income. A salary income is taxable in India in relation to services rendered in India. But if I rendered services outside India, then income is not chargeable to tax in India. Now today, practically, one genuine problem every businessman faces. An Indian businessman wants to appoint somebody outside India for evaluating the market. He would go to customers, he would go to competitors, he would go to different agencies, he will go to certain marketplace and evaluate that do I have a business opportunity in relation to this product outside India. Now this person, I can appoint him as an employee or I can appoint him as a consultant. What is salary? A creation of an employer-employee relationship. And I don't want to go further to this. Everybody is aware what is employer-employee relationship. If I appoint as an employee and if he renders services outside India and if I remit every month 2 lakhs of rupees salary, I am not required to do any withholding. Because under 192, read with section 912, the income is not chargeable to tax in India because it is in relation to services rendered outside India. But the moment I say is a salary, I have a provident fund ESIC gratuity obligation in India, and I also have a similar obligations in the country in which he is working. And therefore, if he is working in USA, France, Germany, UK, Dubai, then I actually need to get registered myself with the foreign social security regulators. And whatever social security obligations are there for an employee working there, I need to do that. Alternatively, I appoint him as a consultant. If I appoint him as a consultant, I don't have a social security obligations in India, I don't have a social security obligation outside India. But then, it will be treated as fees for technical services under 917 because the principle is, am I utilizing those services for India business? Answer is yes. And in that case, you would have to do TDS, which is now 20%. So the question is, it's a cost-benefit analysis between designating him as a salaried employee versus a consultant, and then take a view that do I need to comply, do I want to comply with social security obligation, or do I want to do TDS? If ultimately he is going to get a credit in the foreign country of this 20%, then maybe it is preferable that I have a consultant arrangement. In India, department does create an issue many times that no, in our view, is an employee, not a consultant, because of the agreement, because of the conduct, because of so many things. At least in foreign country, I have not experienced till now. And therefore, one will have to take a business view that should I be appointing him as a consultant, should I be appointing him as the employee. And the second issue on 912, that in large corporates, including MNC, when the people come to India for working for a limited period of time of 2 years, 3 years, 4 years, what we call expats, certain portion of the salary is paid outside India because their family is situated there, their legal employment continues outside India, they want to continue with their social security contributions. And therefore, if my salary is 1 lakh, I would pay 40,000 outside India, 60,000 in India. The question is, do I need to deduct TDS on entire 1 or only 60,000? The answer is simple, it is on 1 lakh. Because entire 1 lakh is paid in relation to services rendered in India, irrespective of 40,000 being paid outside India. And we have a Supreme Court judgment of Illy Lilly exactly on same issue. How do I comply TDS provisions? How do I comply 192? What happens into transfer pricing? I would request Rinkesh to call me again. I will skip subclause 3, dividend and government employee and a diplomat. Let me go to clause 5. What is interest? If you read definition of interest under section 2, clause 28a, they uses two terminology, date incurred or monies borrowed. If I borrow money or a debt is incurred, and if I make any payment pursuant to that, then it is an interest. A fantastic analysis recently, before 15 days, a Delhi High Court made that whether a guarantee charge is recovered from my subsidiary company is an interest or not. And the Delhi High Court said it is not an interest because neither it is date incurred, the obligation may arise in future if the foreign subsidiary failed to make payment. There is no present obligation, either a date incurred or a money is borrowed. And if you are really interested, read a Vijay shipbreaking judgment of the Gujarat High Court. It's 20 years old, Justice Abhichandani. They have explained what is date incurred and monies borrowed in relation to an interest. That judgment has no more become relevant now, but principles are well explained by Gujarat High Court. Section 915 says that if I borrow money for the purpose of business in India, then it is taxable. But if I borrow money outside India, for the purpose of business outside India, the language uses source of income outside India, then that interest is not chargeable to tax. And therefore, let me ask a simple question. I am an Indian company. I have a Singapore branch. Under section 6, a branch is a resident in India. And a Singapore branch borrows money from a State Bank of India Singapore branch. And when a branch makes a payment of interest to a State Bank of India Singapore branch, do I need to comply 195? Let me take second situation. I go and borrow from a Citibank in India, and I make payment of interest to Citibank on a monthly basis on working capital, a term loan, or a BNP Paribas, or any foreign bank other than Standard Chartered, because Standard Chartered is a subsidiary, all other banks are a branch of a foreign company, foreign bank. Do I need to comply 195? On a first situation, what will happen? I am an Indian company. I have a branch outside India, which is a resident in India, and I borrow money from State Bank of India Singapore branch. Do I need to comply 195, or do I get exemption under 194A because I am making a payment to a scheduled bank, and therefore I don't need to deduct in TDS? Somebody can try. The answer is no, because the State Bank of India branch is also a resident of State Bank of India in India, and therefore one resident is making a payment to another resident, and therefore 195 does not apply. It would fall into 194 capital A. 194 capital A exempts TDS on making a payment to a bank. But in a second situation, I borrow from a foreign bank, which is a branch of a foreign bank, and I make payment of interest to a foreign branch, the Indian branch of a foreign bank. Where will I fall? Any person making a payment to a non-resident in respect of income chargeable to tax. હમણાં પ્રેસિડેન્ટ આવે છે, મને એવું કીધું, એટલે તમારા બધાના ટેક્સ ઓડિટ રિપોર્ટ આપી દઈએ એમને. The branch of a foreign bank is a non-resident, and therefore when I am making a payment, a resident is making to a non-resident, and therefore I have an obligation of 195. Practically we don't deduct TDS because under 195(3) every bank obtains a nil withholding certificate on the 1st of April, when they say that we will discharge liability through an advance tax. So ideally and theoretically, when you sign a tax audit report, you should have that certificate in your file as a part of a document. If you go and ask your client, again client will change the CA. Yes. આપણે ક્વેશ્ચન્સ પછી લઈએ. અચ્છા, ઓકે. Sorry.
Yes. A wholly owned subsidiary company is formed in India. The company formed in India is borrowing money from its shareholder located in Switzerland through ECB, and now they have to pay some interest. Whether TDS needs to be deducted, and is there any benefit of DTAA tax treaty?
Interest is chargeable to tax in India, except under 194LC and 194LD. There was a lower withholding tax if you fulfill those conditions, but otherwise interest is chargeable.
So TDS under
It is utilized for the purpose of business in India.
Yes. Okay, thanks.
The most difficult section called royalty, and even I don't know after 30 years of practice. Generally, royalty would mean that a payment is being made for right or right to use certain intangible or certain rights which are owned and possessed by a third party. So if I make a payment for use of a brand, if I make a payment for use of a know-how, then it is all royalty. And I would believe that generally that would be an understanding with all of us. But then the definition has been extended substantially to so that certain situations will also be a deemed royalty. If you read the 916 explanation 2, it says any consideration paid for right or right to use patent, trademarks, intangible, so and so, and the entire controversy is on bracketed portion called granting of a license. So even if somebody grants me a license to use, then that granting of a license and a consideration thereof would also be treated as royalty. The law also extends to what is called a secret formula, a process, or payment for use of scientific industrial equipment that also is treated as a royalty. what is process, what is secret formula, what is right or right to use or payment towards scientific industrial equipment will be based on each of the facts. And then you had certain judgments of the courts which had taken certain views which the government was not in favor, and therefore retrospectively they inserted explanation 4, 5 and 6 in the law, and it was inserted in 2012 but applicable from July 76. And therefore this explanation 4, 5, 6 has created a huge debate and litigation. Let me take a classic example of a software. Now, before I go to software, let me also make 2 or 3 comments. Right now, the practical difficulty with every business faces is the mode of payment. I may make payment through a banking channel. I may make payment online, or I may make payment through a credit card. The concept or principles of law would be that the mode of payment does not change taxability. So if I make $100 payment through a credit card versus a $100 payment through a banking channel, the law will not change the answer. If it is a royalty, it's a royalty. If it is not a royalty, it is not a royalty. And why I am saying so, that though there are certain favorable judicial principles, બંધ કરો ને ફોન કરી બરાબર ત્યાં સુધી બોલ્યા કરીશ. Many businesses, particularly the startups, technology-oriented businesses, are making payment through a credit card only. They make online payments. They do not know who is the other side. And therefore, the problem arises that how do I comply the law? Even if I want to comply the law, how do I comply the law? Because if I take a view that it is a royalty, and the other person is not aware, I have to buy $100 software or a license, I have to actually do a grossing up under 194 capital A, and therefore the effective tax cost will be 25%. So on $100, I will pay $25 to government. So my effective cost is $125. And therefore, and I understand that the CBDT and the banking institution RBI is working on some methodology, like what they did for TCS at 20% on LRS. There is some discussion and methodology is being worked out between banks and the CBDT. How do I apply 15CA, 15CB methodology for an online or a credit card payments? I'm not sure what could be the answer, but let's see what happens by the government. Now, what explanation 4 was inserted? That any payment made for a software would be treated as a deemed royalty, and therefore every payment of a software under a domestic tax is a royalty. So if you buy a licensed copy of a Tally or a Zoho, because the same definition of royalty is referred in 194J, you actually need to deduct TDS under 194J. But if you go to treaty, the explanation for wordings are not found in the treaty. And the Article 12, which is either US, UK, whichever treaty you take, normally would say the payment for right or right to use a copyright. And there, a terminology called copyrighted article versus a copyright is now found placed in a Supreme Court judgment of engineering analysis. And the terminology actually found place in the US IRS explanation. What is copyright versus what is copyrighted article? You and I all buy Chaturvedi Pithisariya or a Palkhiwala or a Sampat Iyengar or a Ramayya. Do I deduct TDS when I buy the books? The answer is no, because all these publications are having a trademark, a copyright, and Rinkesh cannot buy one copy of Chaturvedi and give it to all of us free of charge. It is actually a violation of a copyright. And therefore, what the Supreme Court finally in engineering analysis took a view that if I make a payment for a mere license of a software without any right to commercially exploit or without any right to copy and give it to my office people, then in that case, it is a copyrighted article, though it is a license, but it's an article similar to your music CD. You buy music CD or download music CD for X amount. It is only a license which is given to you to listen that music. You can't go and sell this in the market. And therefore, if I am not able to commercially exploit that copyright, if I am not able to do a copy of that copyright or a software or a book or a musical CD, then it is an article and not a copyright. In that case, under Article 12, it would not be treated as a royalty. The only condition is that all software payments are today similar to these, which is called off-the-shelf software, are not taxable in India under 195, read with section 916, only under the treaty and not under the domestic tax. And the moment you use a treaty, you need TRC and 10F. So if you buy a negotiated license from Microsoft Singapore, he may give you a TRC. But if you buy online, if you make payment through a credit card, you don't know who is the other party. And therefore, the question is that yes, under treaty it is not taxable, but unless you take a TRC or 10F, you can't take a treaty benefit, and therefore you run a risk of a non-compliance tomorrow. The second, and one caution, the Supreme Court judgment is only applicable to 4 situations which are explained in the judgment. And today in practice, department in every software payment tries to distinguish those 4 situations and take a different view. And therefore you litigate. So therefore, when you take a benefit of a Supreme Court judgment, try to explain in your facts that your license, your software purchase is similar to what is referred in the Supreme Court. So that even in litigation, you are able to succeed based on Supreme Court judgment. Though that judgment is pending for review at the Supreme Court level, department will file a review petition, but let's see what happens by the Supreme Court. But if I make a payment for a software development services, I go to SAP and I say, I want these modules to be modified to my requirement. And if I make a payment, it is a pure fees for technical services. There is no engineering analysis. There is no off-the-shelf software. There is no royalty. It's a pure fees for technical services. And therefore, that would be subject to the compliance and the withholding. The only debate, and where I have been able to find only one judgment, that if I buy a software with a source code, am I making a payment for services? Am I making payment for right or right to use? Or am I buying the product? If I take a view that with a source code, I am actually buying the product, then can I go and argue that it's a purchase of a product which would be more treated as a business income, and if it is no business connection or P in India, then income is not taxable. It should not fall into royalty or FTS. There is an old judgment of a Devi Ashmore 192 ITR of a Calcutta High Court, which Calcutta High Court takes a view that in a royalty or an FTS, if I buy a particular intangible, like a brand, then it does not fall into clause 6 or clause 7. It will actually fall into clause 1, and therefore I am not required to do any withholding. सुनील प्रेसिडेंट આવશે ત્યાં સુધી ચલાવીશું ચિંતા ના કરતો. So lunch is delayed because Honorable President is on the way to meet all of you, and I will continue till he comes. So bear with me. I am sorry. No problem. Yeah. Mic આપજો ને. कैसे हो पीयूष जी? Sure. Are we making a last sentence? It would be a scientific industrial equipment. Machinery would fall in industrial equipment. Yes, it's by law. That's a deemed extension of a royalty definition. So let me take the same example forward. So there are two subset of equation. A foreign company makes a payment to an hotel for using the hotel rooms, and the agent who books the hotel is being paid a commission by a foreign company. Am I right? No, no, that, so वो सब बड़ी बड़ी टर्मिनोलॉजी है, खाली फैक्ट समझते हैं. So, foreign company has booked Crown Plaza 2 rooms, and for Crown Plaza booking, there is an agent called Flamingo, and foreign company also makes $100 payment to Flamingo for a commission charges for helping to book Crown Plaza 2 rooms. Am I right? Facts? Okay? So दोनों में नहीं. क्यों नहीं? हाँ, वो वाई का आंसर चाहिए. आंसर तो मिल गया. वाई न्यू? So when a foreign company makes a payment to Crown Plaza for using 2 rooms, he is making a payment in the nature of a business income to a Crown Plaza, and therefore unless there is a business connection or a permanent establishment, the income is not taxable. Now in your case, there is a reverse situation, because the foreign company is making a payment to a Crown Plaza. Crown Plaza anyway is taxable in India being a resident company, and therefore Crown Plaza, whatever that income would accrue, would pay the tax. So there is no issue of 195 when a foreign company makes a payment to an Indian hotel. But if I take a reverse situation, that I travel to USA and I book Crown Plaza rooms, do I need to do TDS in relation to a Crown Plaza rooms in the New York? Again, answer is no, that it is not taxable. Only a slightly different context. Please go to board circular number 194I and an Andhra Pradesh High Court judgment of Krishna Oberoi on what is control and where do I need to deduct TDS on the hotel rooms. Just look at it. On your facts, answer is no. Pardon? Commission, no. Again, same. Principle, no. It's a business income. So let me take that machinery example further. So in all foreign companies, I take or use the servers owned by my parent company. So the SAP infrastructure, license, servers, everything is owned by my parent company. An Indian subsidiary or an Indian outfit will use the server and will pay per user charges. Now there are 2 or 3 components to this payment. Component number 1 is a pure use of a server and an IT infrastructure. The second payment is use of or a license cost sharing. And a third is a IT infrastructure maintenance cost of those IT division of the parent company. On the first issue for use of an IT infrastructure, the computers and server would be treated as scientific industrial equipment, and therefore it would be a deemed royalty. Now, prior to insertion of an explanation 5, there was one argument in favor of a taxpayer that a payment for a use of a scientific industrial equipment would not be treated as a royalty unless and until the asset is in my possession or asset is under control. And there are a large number of judicial decisions on this, that all these IT server payments are not taxable because that server is neither in my possession nor under my control. There is a judgment of an Asia-Set satellite of Delhi High Court, which also took the same view that a payment for a transponders for relaying the TV channels, which is a payment for scientific use of equipment, unless that asset is under my possession or control, it is not chargeable to tax. Explanation 5 overruled all the judgments, and that is with retrospective effect. That I don't need to see possession or control over the asset. So do I have a control? Do I have a possession? I don't have to see. The mere payment for use of scientific industrial equipment would fall into a deemed royalty. But similar to software, the explanation 5 does not find place in the treaty. And therefore, if I have a treaty with a foreign country, then under Article 12, normally in majority of the treaty, let me make this statement, majority of the treaty would use of scientific industrial equipment as a royalty. Some treaties do not treat scientific payment or industrial equipment payment as a royalty. If it is not, then you go out of threshold. But if it is, then can you take an argument, the same principle prior to 2012, that the asset is not under my possession, asset is not under my control, and therefore under treaty, this payment is not taxable? My personal view answer is yes, it's a correct argument, but ultimately you will have to litigate, at least at lower level, nobody would understand and appreciate this distinction. The same principle, if I apply what is called a cloud sharing services or hosting charges which you pay on the technology world. So when I make payment for a cloud sharing services, the question is that am I making payment for a hardware or am I making payment for storage of my data, and which is akin to services and not akin to a use of a scientific industrial equipment? I would believe that I am not making payment for a scientific industrial equipment, I am only making payment for storage of my data, and he is rendering me a cloud services for storage of my data. Similarly, I host my domain name, I host my data on the server of somebody. Am I making payment for the use of that server? The answer is no. I am only making payment for the services for hosting my domain name, hosting my data on the server. And therefore, one argument that it is not a royalty, it is more in the nature of fees for technical services. Supreme Court, in a fantastic judgment of Kotak Securities, and you must read this judgment, para 8, made a fantastic distinction between a facility versus service. What was the facts before Supreme Court? A Kotak Securities was making a payment to NSDL for use of the lease line charges for trading of securities. It was a lease line provided by NSDL to Kotak Securities as a broker, and he was making payment to NSDL for use of that lease line charges to NSDL. The question was that, am I making payment for a services? The AO took the view that yes, you are making payment for a technical services. NSDL is providing you services in the form of a lease line. CIT confirmed, ITAT confirmed, Bombay High Court confirmed, Supreme Court reversed. Supreme Court made a distinction between a facility and a service. Supreme Court said, if it is a standard facility available to everybody, then there is no service element. A service element would presuppose that there is a tailor-made, there is a recipient of a service and a provider of a service for a particular nature of services. And if I as a chartered accountant provide an audit services, I provide to a particular client and therefore it is a service. I as an advocate appear before a client, it's a service to a client because it is need-based, tailor-made to a particular client. But if I use a mobile services of a Vodafone or a Bharti or a BSNL or a Jio, am I availing services or am I availing Vodafone mobile facility? The Supreme Court said it is a facility because it is available to anybody at a standard terms and conditions. The same principle, 30 years back, Madras High Court in SkyCell Communication. Again, it's a very good judgment, 251 ITR. That something which is standard services, which is available to everybody, which is not tailor-made for a recipient of the services, it is a facility and therefore it does not fall into definition of fees for technical services under 917. So the question is that cloud sharing services or an hosting charges which is applicable to everybody who I can go to any cloud storage services, you can go to cloud storage services, there is nothing, the charges are fixed on the number of the data which is used, the storage space which is hired, and therefore what I am not concerned is about an equipment, what I am only concerned is a cloud storage facility, and therefore it is neither a service nor a payment towards use of a scientific industrial equipment, and therefore it is neither royalty nor FTS. And there are good amount of tribunal judgments accepting this principle. But yes, I must admit it's a litigative position and one will have to litigate. For example, all diamond traders in Surat and Bombay gets their diamond graded through a foreign agency called GIA. Indian manufacturing company go to ISI for your product certification. Whether ISI by giving a certificate of a product, is he giving me a services or is it only a facility to grade my product, to approve my product as ISI compliant norms? When I go to as a diamond trader, am I availing services of a particular nature or am I only availing a standard facility of a grading report? There is a judgment of a Bombay tribunal in TUV where exactly same principle is accepted by a tribunal in a Bombay High Court judgment. So this facility versus service is a good amount of argument when you go to FTS or a royalty, and you will have to understand that what is the dominant purpose of my payment. If I make a payment for a services, you would fall into 917. If I make a payment towards use of an equipment, I will make a payment of under the royalty. FTS definition uses technical, managerial, consultancy. Technical ideally would include a professional services. There's an old judgment of a Supreme Court in reference to ATRRA that Supreme Court said word technical would include professional. And therefore, the question is that if I appoint CPA in the US and I make $100 payment to a CPA, the only question I need to ask is, am I utilizing these services for the business in India? If answer is yes, then it falls into 917. But if I make a payment to a CPA in the US, I can take the benefit of a treaty, either a business income or an independent personal services or a Article 12, what is called make available, which slightly, give me 5 minutes, I'll go to that issue. The managerial. The word managerial would include a management services, something which a management is supposed to do, but it is outsourced to a consultant, and therefore it is more of a management role, what we have understood under section 144 of the Companies Act. And then the consultancy, it's a very, very generic terminology, but again, one would have to make a distinction between a facility and a service. Am I providing a consultancy services or am I only providing a facility? If it is utilized for the purpose of business in India, then it is taxable. The place of rendering of the services is irrelevant. After the substitution of explanation 2 times, the place of rendering of a service is irrelevant. Even if I have not seen India even on a map or physically, but if I render services outside India, but if it is utilized for the purpose of business in India, then it would fall into a fees for technical services. And for example, many real estate builders who avails architectural services from outside India, those architects would never have traveled to India, but architectural services, more probabilities that it is a technical services. I know there are certain contrary judgments, but I would personally believe that it's a technical services. As I said, a distinction between a facility and a service. The question would only arise about how do I take a benefit of a treaty. Now, before I go to treaty, let me summarize what I understand as the steps to meet what is income chargeable to tax in India. I would believe that the first thing is, am I making a payment to a non-resident? And then, whether income is chargeable to tax in India. Now, to decide that, the first step is, what is the character of the payment? If the character of the payment is business income, it would fall into 911. If it is services, it would fall into 917. If it is royalty, it would fall into 916. If it is interest, it would fall into 915. Now, before I go to even section 9, I must examine 5.2 also. Because I may not have deemed to accrue res principles fulfilling under 9, but if I have received or deemed to be received, I may actually don't need to travel to section 9. And therefore, I first examine section 5, subsection 2, then I go to section 9, define the characterization of the payment, whether chargeable to tax in India or not. If answer is yes, then and then I travel to a tax treaty. Treaty cannot create a charge of a tax. Treaty can only reduce your charge of a tax or avoid the charge of a tax. It cannot create a charge. If domestic tax is not taxable, I don't need to go to treaty. If it is chargeable to tax even under treaty, then the question would arise at what rate. Again, I would examine between a treaty and a domestic tax, like royalty or FTS. Majority of the treaty would have 10 to 15%, domestic tax at 20%, and therefore I would take a treaty benefit of 10 or 15%. So characterization of the income, 529, section 9. If answer is yes, I will go to treaty. If answer is no, I don't go to treaty. The new levy, what is called equalization levy, and why it is relevant are all your online advertisements, online services, e-commerce transactions, everything is now falling into equalization levy. And we have an amendment in section 10, clause 50, which says if it is chargeable under EQ, equalization levy, then it is not chargeable as royalty or fees for technical service. In 2016, for the first time, the equalization came, particularly for online advertising and marketing. And what is the distinction between these two? Please read a Calcutta Bench Tribunal judgment of a right florist. It's a fantastic judgment on what is online advertisement and marketing. And the Calcutta Tribunal took a view prior to equalization levy that hosting of an advertisement or marketing on a Google platform or a Yahoo platform is a business income. Unless Google or Yahoo has a business connection, it is not a royalty or a FTS. But then you had an equalization levy from 2016, where you have a 6% you have to pay to the government. Indirectly, that cost will come to all of us because ultimately that foreigner does not pay the tax. It is loaded into the cost and ultimately it is passed on to the customer. In 2020, a equalization levy was extended on online purchase of goods and services. And if I purchase goods online, or if I avail services online, then there is a 2% equalization levy. And in that case, also the foreign company has to pay 2% equalization levy on the gross amount. In the interest of time, I don't want to go to what is online purchase of goods and services. There are certain conditions. And one of the conditions, which I would believe is creating an issue, is making an online payment through a banking channel to a foreign supplier. Now, every payment is made online through a banking channel, and if I treat every payment online through a banking channel as an equalization levy, I don't need section 9, I don't need section 5. But one will have to understand in a perspective, because it is all coming from that base erosion profit shifting action plan 1 about digital economy. The finance minister, I'm sorry to use that, the old finance minister had made a statement in the parliament that once we come out with the pillar 1, pillar 2, we will delete SEP provisions and equalization levy. Now let's see what the new finance minister does and from which political party is assuming charge. Now, if there is an equalization levy applicability, then it does not fall into FTS and royalty. And therefore, as a part of your due diligence process on online advertisement and marketing, or purchase of a goods or services online, you must first take a declaration from a foreign service provider or a foreign supplier that he is not subject to equalization levy. If he is subject to equalization levy, matters is over. But if he is not, then you will have to examine, do you fall into any of the clauses under the domestic tax? Sir, yeah.
After a long time listening to you.
Yeah, so I think I will sum up. And when I started, it's a good topic, good subject to learn, and it's an evolving subject. I wanted to take few minutes on pillar 1, pillar 2, but we will discuss at some point of time. Thank you very much.